StatsCan just released its latest CPI data. The consumer price index rose 2.4% year over year in December, up from an increase of 2.2% in November. On a seasonally adjusted monthly basis, the CPI rose 0.3% in December. So here to talk about those numbers is Charles St-Arnaud, chief economist at Servus Credit Union. It's good to have you. We've, of course, got Dan Rahinton still in studio as well. Sir, 2.4%, this is above what most economists were expecting. Are you surprised at all?
It's slightly surprising. I think when we look at the details of that, we knew there was some upside pressure in December because of a base effect. If you remember last year, we had the GST holiday on many items, especially on food. That kind of dragged some of the CPI lower, and now we're kind of having some of the payback from that. But when we look into details, it seems like some of the price, I was looking at the transportation sector. We knew gasoline prices were a big drag on inflation last December, but the overall transportation sector seems to have increased more than what I was expecting.
What do you think about the dynamic on the food inflation side and how that will direct basically the Bank of Canada? Because they don't officially look at it in its totality, but clearly it plays a role in discretionary incomes for consumers.
Yeah, well, I think when we think about it as what the Bank of Canada will look, I think looking at more on the core measures, so for example, CPI median, CPI trim, are still moving in the right direction. Actually, CPI median is now at 2.5%, so quite a decent deceleration last month. So they kind of focus a bit more on that, and they take a more holistic approach on inflation and not just focusing on one part. But when it comes to food inflation, it matters. Like a lot of economists love to look at excluding food and energy, but at the end of the day, households spend almost 30% of their, or 20% or so of their disposable income on food items. So it has a big importance, and we've seen throughout, especially in the second half of 2025, a lot of what we've seen in terms of stickiness in inflation and increasing inflationary pressure has been driven by food, and that seems to be continuing again in December.
And just to pick up on Dan's note there about the Bank of Canada, right? Like I believe Tiff Macklem was saying if inflation stays around 2%, so 2.2 was enough to keep rates steady, you know, the Bank of Canada wasn't going to cut again. Is 2.4 high enough to see some change? I know you touched on that briefly, but I mean, could we see changes because of that?
I don't think on the surface, I don't see anything in the report today that would change my view on the Bank of Canada. My view is that the bank is really firmly happy with where rates stands at the moment. They're still willing and ready to act if needed. But at 2.4% is not an issue. And they've had warned that in the first few months of 2026, we would have some volatility in inflation, headline inflation, especially coming from changes in the GST last year, the carbon tax removal also in April, and that they will look through some of that volatility. So I'm not too concerned. What it will look more in that type of volatility is more what's going on under the hood. And so far, there doesn't seem to be any big worry at the moment on that side.
Have we seen the tailwind from lower mortgage rates now turn into a headwind? And how do you see that playing through and feeding through the inflation data? Because that's clearly a big part of the basket, if you will.
Yeah, well, that mortgage interest cost is getting less and less of a push on inflation. We're seeing, yes, still people are renewing their mortgages at higher rate, especially those who bought in late 2020, early 2021, will see an increase in their interest. So that's still having a bit of a tailwind in inflation, but much less. Where we're seeing a lot more impact on the shelter cost is we're continuing to see more and more of that lower rent feeding into shelter, or less increase in shelter costs. And the same on the owned accommodation. We have house prices throughout Canada that have been drifting lower slowly, and that is going to put some headwind on that component of inflation, especially in the first half of this year. So I'm not too concerned on the shelter side for this year.
You talked about the fact that food prices, you know, we're continuing to see that trend where food prices, whether it's eating at restaurants, groceries, what have you, that's driving inflation up. But we're seeing, of course, you know, consumers paying less for gas in December. Is that also a trend we could see, maybe, that gas prices will continue to go down? And could that also level out?
Yeah. Well, that obviously the problem with gas prices is that it's so volatile. We never know, and I can just see it from here where I stand in Alberta. Like we had gas prices below $1 during the Christmas period, and now we're about closer to $1.30. So that's volatility. It's still low when we compare like $1.30 compared to what it was like over the past 2 years. Some on the low end, but because the inflation is the month-over-month change, just that little change will push inflation higher in January if it was kind of just that component that matters. So yes, it still remains low, but it's still more on a trend. Where I'm a bit more concerned on food inflation is more how sticky it has been, but also you have to take into account that food being such a big part of the basket, either through CPI or either through the what consumer are spending, is that it has more influence on inflation expectations and other components, for example, like car prices. So that's where that stickiness in food prices could have or could mean some stickiness on the inflation expectations down the road. But with headline inflation around 2% or slightly above 2%, it's not something that would concern the Bank of Canada at the moment.
So when you think about just the idea of inflation expectations and how that filters through, especially through food, as you eloquently laid out, that normally means implicit wage pressure and that spiral that we've seen in more emerging market economies. But how do you contrast it with the lack of basically the building slack in the employment market? So will we have even that wage pressure that we would see in otherwise in economies where inflation expectations are climbing?
Yeah. Well, I see at the moment, like when we look at wages, is that there's not enough. Obviously, there's the amount of slack in the economy, the uncertainty with the trade policy and where the economy is going with all the threat from the U.S. It's a more difficult environment for workers to ask for better pay. And what we've been seeing mostly in terms of wage increase is actually wage increase to keep purchasing power constant. Actually, when we look at the data, real compensation of employees has barely changed compared to where it was in 2019. So we're barely making enough. We haven't seen any real gain in purchasing power based on just on compensation over the past few years. The only gain on purchasing power has been those households that have or that owns assets have seen greater return on those assets, and that's actually where disposable income has been increasing, or real disposable income has been mainly increasing for households.
Okay, that's all the time we have. Charles St-Arnaud, Chief Economist at Servus Credit Union. Appreciate you joining us today and breaking down the numbers. Thanks so much.